So Mauricio,
Yes.
you feeling fat? You want in?
Do I want to know what?
You want in? Just say you want in.
Wait, you started this with, so let me get this right. You started with the qualifying question, do you feel fat? And the answer to that is yes. And then the next one is, are you in? Which tells me this is like some freaking 72-hour fast or something, that water fast that you want me to do or something. Is that right?
Nope, we're doing a
It's longer. It's 12 weeks.
12-week.
I'm out. I'm already out. I'm out. 12 weeks, whatever it is, I'm out.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 29 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and I'm joined by all three co-hosts this week after a short hiatus. I missed you guys. It's good to be back. But how's it going, Jay? How was your holidays?
It was great.
First of all, are we going to start with Jay again at the beginning of the year? I thought it was new year, new season, new resolutions, and we still go back to Jay first time every time.
Here's the thing. In Riverside, it orders it on my screen, top down, based on who joins first. And Jay's always the first to join, then you, Mauricio, and then AJ's always last. He always shows up 1 or 2 minutes late. So it's just the order in which my eyesight goes.
All right, fine.
He sorts it by best looking.
and
then goes in reverse order. It was good. I gained, I gained about 10 pounds. And so that means it was probably a good holiday. And my kids got an Xbox, so I haven't seen my kids in about a week. I guess that's good for them. And it was a good holiday. How about you?
Well, what are you drinking over there?
I am drinking some Knob Creek smoked maple bourbon again.
You like it, huh? That's the third time.
I do. It's good stuff. Yeah.
Awesome. Mauricio, how was your holiday, bud?
Dude, holidays were great. AJ, you're going to be happy to know that I was the first one that had the Christmas tree up. The Christmas tree is already down.
Wow.
Efficient.
All right. So
we're efficient, baby. We're
started
efficient.
4 months ago, and then you took it down within 4 days after Christmas.
Dude, we are on top of things. We moved on. We're already making plans for Easter, I think it is. Is that what we're working on?
Valentine's Day's next. Jeez.
Yeah, we don't do Valentine's Day. We do a family Valentine's because my wedding anniversary is like a week before. So we always do a big wedding anniversary thing. And then Valentine's is always with the girls. We do a family Valentine's. We had a great Christmas, though. A lot of parties at the house, a lot of boozing. I didn't gain as much as I thought I would, so that's good. But I'm back to drinking my favorite. This is my favorite. This is becoming my favorite go-to wine, the Lewis Mason. Love this sucker. It's one of my favorite cabs.
There's no stopper on the top of that. What's that little stopper that you keep talking about? That
what stopper?
Like then you always talk about this thing that preserves your
Corbin?
wine.
No. Yeah, I had the Corbin actually because we opened this up a couple of days. That's why I haven't. It's not like I've been drinking this whole thing during the last 5 minutes. So anyway, everything's good, man. Good to see you guys. I for the record, I was totally against taking a break. You guys were slackers and decided to take a break. I was ready to go, but I'm good. It's good to be back.
Awesome. AJ, how's it going over there, man? How was your holidays?
It was good. Just hung out, relaxed, the kiddos, watched them crash motorcycles and four-wheelers. Well, that was great.
You get any new dinosaur heads as a gift?
You know, I didn't, although there is a Triceratops skull that is circling. But I'm holding...
Isn't that basically the same family of the one you already have, though? Like, you got to mix it up.
It is. So Ernie and the Triceratops are very close. But I'm holding back restraint, and I think my wife said no more dinosaurs for a little while.
Unless the new one's a female, and then you could breed Ernie in the new one and maybe get some more...
That's a big... I bet you I could make a lot of money doing that, right?
It's an investment. It's not a purchase. It's an investment.
You drinking Diet Coke again for us?
That's right. Fountain drink, Diet Coke, the good stuff.
What goes in the decision-making process of going with the red cup versus the clear cup, AJ?
Whoever bought them and stacked them into our kitchen here at the office, that's the decision that I make. Whatever they decide for me.
Once again, it depends on what the assistant decides.
That is correct.
But I'll tell you what, I bet he doesn't ever get blue cups.
I'm not going to lie. The banter in this episode, it's clear we've been off for a couple of weeks because I feel like we've got nothing.
You don't want to hear about everybody's holidays, Jay? Wow, there's Scrooge over there. Jeez. All right. Well, I'll start with mine. Actually, last night I went skating with my kids. It was great. It was my first time on skates in like over a year. So I'm going back to my roots.
You fall down?
I did not fall down.
Did you just like take down a bunch of kids, like just plow them over?
Well, it's funny for like the first 5 minutes, you're like, geez, I forgot how to skate, but then it just comes back. It's like riding a bike. And then I was just flying around, tormenting my kids. And then I got as one of my gifts, actually, it's funny. Once you put out that you're a bourbon drinker, then all of a sudden next Christmas, you get like 6 bottles of bourbon. But so part of one of the bourbon gifts that I got was Angel's Envy, and it was engraved. It says, I don't know, can you see that? Merry Christmas.
Nice.
And my name on it. I never know what to do with that. Even an engraved bottle, like, are you allowed to drink it? But
no, you display it.
Got to keep the bottle. You just got to keep the bottle.
An empty bottle display. Apparently, I got to add that shelf to my bar. But
yeah, if anybody wants to send me bottles of wine engraved, I'm up. I'm up for that.
Likewise, or not engraved.
All right, well, let's get this started here, boys. So this is a bit of a different episode. Since it started the new year, we're going to do a predictions episode. And so Jay usually draws up the spreadsheet for this. And he was like, we got to switch this up. We were talking way too much about statistics last time. We were throwing out way too many numbers. It got too confusing. Let's just do a more general one. And we all agreed, okay, that's a good idea. And I realized why he did that, because when I went back to the previous predictions and the list of winners, and Jay did not win a single prediction. So that's probably why he doesn't want us to go through the predictions from last time.
Don't hold me to any numbers.
but he did put a lot of effort into picking new prediction classes. So just out of respect, I will go through the new ones, and I'll sprinkle in some of the times that Jay lost. So let's start off talking about real estate. And it was a pretty tumultuous year, 2023, a lot of ups and a lot of downs, mostly downs. But 2024 is shaping up for a little bit better run. So what do we think here is going to be the best performing asset class for 2024? I'll go from the bottom up this time. Let's start with AJ.
The best performing. Okay, this is
I like how AJ's like not even prepared. He didn't even know what the question was going to be. We sent this spreadsheet out a week ago, and he's just like, that's a good question. Let me think about
great
this.
question. Let me consult my data.
My assistant number 84 is not here. First of all, nobody looks at your freaking spreadsheet. Let's just get right, AJ. Like, we don't have time for these spreadsheets. Come on, we're above the spreadsheets. We don't look at that. It gives me a headache.
Just predictions off the cusp, but that's fun.
Now, the predictions, though, we're talking commercial real estate or all real estate.
Dealer's choice here.
Okay, I'll actually go with the housing market.
In general. So the residential real estate is the best.
Residential real estate, I think, will outperform most other asset classes.
Do you split? Wait. Do you split that up between single family and multifamily, or are you just all about like you grouping them all together?
Single family homes. I'm talking.
Oh, you're talking single family.
Yeah. And I think the reason why I look at that, normally when we're looking though at returns, we're talking about normally sales and equity and how much has gone up, right? I think that a lot of the sell pressure on commercial real estate, I don't feel like interest rates are going to change substantial enough to give commercial real estate this big necessarily boom in valuations, right? And I think that there's still have a lot of headwinds on supply and different things in a lot of the different sectors. And it's also a presidential election year, which we see a decrease in demand in a lot of things like hotels. And so I think in general, though, everybody's held off buying so much in single family homes that, we went through a year and it just stopped. I think that a little reduction in interest rates is going to have a much higher drive for consumer demand on single family homes. And that has had a really, really low amount of supply coming out, and that hasn't been taken care of. So I think it's just more sensitive to the interest rate environment and the changes that will happen on the buy side in real estate right now.
That's fair. All right, let's get Mauricio's take. Mauricio, what do you think the best performing real estate asset class?
I'm going to take the complete opposite of that one. No, I shouldn't say the complete opposite. I shouldn't say the complete opposite because I don't know if it's going to be. I'm already back.
Well, next category is worst performing. So if you want to go complete opposite, you could say single family is going to be worst performing in the next half.
No, I just wanted to address. I just wanted to make a point because this is a good chance for me to make a point here because a lot of people have been talking. I think this is kind of where you're bringing this point up, AJ, that we're kind of quote unquote undersupplied in the residential real estate market, right? And if you look at the pricing over the last 12 to 18 months, we're pretty flat over the last 12 to 18 months. A little bit, I'm looking at the Case-Shiller index from home prices. It's a little bit higher, but basically flat, which means that even though we have low supply in housing, we also have low demand. And the part of that is because of the high interest rates for sure. And a lot of people are locked in, all that stuff. But I don't think you can argue that we're undersupplied if the prices stabilize. I think demand and supply has come into equilibrium over the last 12 to 18 months. And so then the question becomes, what happens with the supply of housing if you end up going into some kind of a recession, which I know we'll get to that in a second, but I believe we will. And so I think a little bit of increased supply of where we are now, the demand's not going to be going higher. I think there's a good chance you'll see the single family home pricing go down because of that. Everybody talks about there being an undersupply. I think there's a low supply, but there's also a historically low demand because of the high interest rates. And I just think when people start losing their jobs, and we talked about this a couple episodes ago, but when people start losing their jobs and they're forced to get out of their low interest rate homes and they don't have a job and they got to get access to that equity, you could see some movement on the other direction. So just wanted to have everybody know what the other argument or the other side of that argument is.
That's good. A little board bet between the two of you. But moving back to the
I mean, yeah, he's wrong, but
AJ knows who's right here. I mean, I'm backing it up with facts and economics and statistics, and AJ's just talking about his dinosaur over there.
It seemed to have served him pretty well so far. But if it's obviously not single family real estate, Mauricio, what do you think will be the best performing asset class?
Gold.
That's not real estate.
It's not a real estate asset class.
Wait, you're saying precious metals, gold and silver is not an asset class?
No, real estate asset class. We're being specific here. This is drunk real estate, so we thought we'd start with that.
Oh, a real estate asset class. I'm sorry, I didn't. The spread. Wait. The spreadsheet must be wrong.
No, I think we should go with it. If gold is the best performing real estate asset class, he wins.
Okay, this is great too, because the best part is there's literally a category later that talks about how will gold and crypto perform. So he's like, he obviously didn't read the sheet at all.
In that asset class, he's going to say hotels.
You guys, can somebody should pull up the spreadsheet, because I swear to God, it's like it's worse than the multifamily underwriting spreadsheets that I get to see every so often. I mean, it is like 100 pages long, 55 lines, 25 different things.
If you look at this spreadsheet, there's an like we're starting with real estate. At the top, it says real estate, and then underneath it are subcategories.
I would rather just get to the top 10, honestly, than to go through your spreadsheet again.
Jay, let's get this back on track. What's your best performing real estate asset?
Okay, so I think there's going to be several. I think there are going to be a couple that are going to do well.
No, wait. The definition of best. Wait, the definition of best is literally one.
We don't have time for our Jay soliloquy right here.
I couldn't even give an answer. Is lecturing me. Okay. I hate being this guy. I hate being the guy that is pumping his own asset class. But let me honestly, last January, I was the first to say I thought multifamily was going to have a tough year. But this year, I think multifamily is poised to do really well and potentially better than any other commercial asset class. And the reasons for that, number one, multifamily has taken a good hit over the last 18 months. I think a lot of people don't realize it because a lot of that hit was taken pretty much instantaneously back in spring and late spring of 2022 when interest rates started to go up. Basically, we saw a drop in values of about 25% almost overnight. And so because that happened so quickly and because for the last 18 months, valuations have kind of just flattened out and we haven't seen a lot more distress, I think a lot of people don't remember that multifamily is off so much from 2 years ago, 2.5 years ago. So I think it has a lot of room to run up. I also think that that we're going to start to see more of, and we've talked about this in other episodes, but we're becoming a renter's nation. And I think we're going to see a lot of people that are going to be graduating out of their parents' house. We're going to see people that are moving into their own places, and they're not going to be buying houses, but they're going to need some place to go. We're going to have increased household formations. So where are they going to go? They're going to rent. And so I think there's going to be higher demand. I don't believe there's going to be as much supply coming online as everybody thinks that there's going to be. So overall, I think, and I don't think multifamily is getting back to our 2-year highs or our highs from 2 years ago anytime soon. But I think it's going to have a really good year, and we're going to get back on track.
Good answer. Good answer. Well, yeah, I do agree that I think apartments will do well, but I think with the flat rents and the large supply coming on this year, I think it'll keep it from being the best performing. I think it'll do well, but I think 2025 is probably better for apartments because we already see in the pipeline, there's nothing in the pipeline for coming online there. But I'm going to go a bit off the wall here. And this is strictly based off of an article that I read. The guy who wrote it was Joseph Ori at Paramount Capital Corp. And he made the case that retail real estate is going to be the best performing asset class this year. And his argument was that basically like 48 years ago, there were so many retailers that just went through the ringer, like bankruptcies of like Sears, Kmart, JCPenney, Neiman Marcus, Toys R Us, like the list goes on and on. We had all these things go bankrupt over the last few years, and the total returns were doing pretty well before that. They were like 51% back in like 2020 or before that. And then it's just been negative. And there's kind of just been this feeling out of retail with online and like trying to figure out where they're positioned and the best strategy going forward. And his position was that they figured it out. Like they've figured out the whole online and, you know, something like food and drug anchored, like they've figured it all out now. And that he thinks that like something like shopping centers with that food or drug anchored shopping centers and net lease retail real estate, that they're just going to have a field day this year. And he convinced me, so I'm going with that.
What about warehouses? Because there's a ridiculously tight. That's a really tight market, right?
Well, let's talk about that in the next section.
By the way, before you get to the next section, AJ, I just realized there's a second tab on this freaking spreadsheet. That's what was the issue. I was looking at this tab that had like 1,000 lines, and I still couldn't find what Kyle was talking about. Now I realize there's another tab on the spreadsheet.
So the first tab says July 2023, and the second tab says January 2024. You mean those tabs?
And the text message I sent you at 4:08 this afternoon, the first tab is last year's predictions with results. The second tab is new predictions for 2024.
Some of us actually work during the day and aren't necessarily tied to our phones and email. I don't even have email. So anyway, go ahead.
All right. Maurice, do you want to give a good an actual answer to this question, or do you want us just to move on to the worst performing?
Let's just move on. I've had enough of this already. I'm ready for the top 10.
Let's start with you though for the worst performing real estate asset class for 2024.
Single family homes.
You think they're going down that much? All right, that's fair, and you made a good argument about that. That's I'd like to see a full debate between the two. You know, that would be a good episode.
I'm surprised AJ didn't go self storage. Where is self storage going? Is that like in the middle? Is it somewhere in the middle? It's like it's found equilibrium.
I think we're now stabilizing, but 2025 will be way better than 2024 for a lot of real estate asset classes. But self storage has still got inventory coming on board and everything. So I think that the lower rates to try to get back to normal, I think 2024 will be good. We'll do better than 2023, but I don't think it's the top.
Well, AJ, what do you think the worst performing asset class will be in real estate?
Gold.
I've debated this one a lot. I think hotels.
Really? The hotels and leisure have been doing pretty well lately.
I know it has been. And that's why I think it'll do poor. I think it'll do poor because of a few reasons. Now, this is like, I'm going out on a limb here with this prediction, everybody. The reason being is during an election cycle. And if we run into a period of a lot of chaos and we have a lot of summer of love again, And I think you're going to end up with a lot of people that will not want to be traveling. And then if you add a real recession in the middle of that.
I thought you were going somewhere else with that, with the summer of love there. So
no. I think we will end up in a position with a recession, if we have a recession too. That's a double whammy, I think, for the hotel industry, as opposed to other assets. Now, once again, though, if everything is just, we have no recession and everybody, this election cycle goes through and there's no protests, there's no mass problems, anything else like that, then yeah, the hotel industry will probably do fine. I just don't think that that's probably going to happen.
Yeah, I was reading an article actually when I was trying to rebuttal this guy with his retail spending, and because there was one article that said actually millennials are more likely to scale back on their retail spending and goods than experiences. That they don't want to give up their experiences, their restaurants, their travel, their things like that. They're more willing to cut down on their Amazon purchases than that. So I thought that was super interesting too. All right. So for my prediction, since we're skipping over Mauricio again, I guess, I still think that's that office is going to be the worst performing. I think that office tenancy is pretty long dated, and we're still having leases expiring, and people think that the worst has already come to pass. But I still think there's a bunch of office owners out there still treading water, just waiting for that shoe to drop and that 10-year lease to expire, and that they're going to be in bigger trouble. So I think it's going to cause some bank issues too.
You don't think that's priced in already, Kyle? Like, you don't think that's priced in? Like, everybody knows it's longer term.
That's what I'm saying. I think everyone is they assume that it's already done, and that's what they've priced that in. And I think there's still more to come with that. That anybody who's not really in the industry knows that. But at the same time, I think that's going to be big opportunity. So if you want to talk about big winners, like if you really know that office space well, or you're good at office conversions, or there's something you're tapped into in that industry, I think there's a huge opportunity for sophisticated investors in that space. Jay, what about you?
Oh, you're actually going to ask my opinion.
What, so do I have to go last every time? I'm sorry.
Jay gets, when Jay goes last, he's pissed off, he's offended. It's like, dude, I should be number one. And when he's not,
Jay's whole life, he's finished first, even with his wife.
Wow, this is going off. Here's my prediction: in the next 30 minutes, this podcast is going to go off the rails.
Okay, I'm going to be a big contrarian here. I'm going against the whole world here. I think next year the worst performing asset class, and I'm not saying it's going to collapse or anything like that. I think actually most of the commercial real estate asset classes are going to do well next year. I think the worst performing is going to be industrial and warehouse. I think we saw a huge expansion after COVID with inventories, and we're starting to see inventories decline. We're starting to see a number of companies that historically would require a lot of manufacturing and warehouse pulling back. We're seeing some declines in revenues. Amazon's the one exception. We know the Magnificent Seven companies that crushed the market last year, but
they own their warehousing.
They own their warehouses. And so, but I think we're going to see just a decline in inventories. And I think we're going to see a pullback on the business side of things. And I think it's going to hit manufacturing and warehouse. And so next year, that is my vote for worst performing asset class.
Well, and it's just the amount of supply, as you touched on online, is just astronomical in there, right? Like the industry's been so gangbusters that they've just been building so much. And like, even in the last quarter, I think because I took notes on this because I had this as my biggest real estate surprise, actually, was industrial. But in the third quarter alone, they had 171.8 million square feet delivered, and there's still 624 million square feet under construction in industrial. So considering that the net lease asking rents have doubled in most markets over the last 10 years, I think the run up is just, it's kind of, you're going to see a bit of a whiplash effect. So I agree with Jay there.
I feel like I need to, obviously, Jay, whatever Jay says, I got to pick an opposing view or something. But I mean, isn't, and I don't know anything, let's be very clear on this. I don't know anything about anything, but certainly not anything about warehousing. But I'm pretty sure warehousing ties to, online, the e-commerce world. And so, yes, even though inventories may be declining, I think the stat you got to look at is what's the percentage of online businesses that are going to be happening over the next, 1, 2, 3, 4 years. And as more and more, businesses go online, and that market's growing. I just saw a stat over here. I don't know how accurate it is, but it's like basically going to be doubling here in the next 10 years. That online businesses have to maintain their inventory somewhere, and that's why they need warehousing. And so Amazon's a great example, but like there's a bazillion new Amazons that are popping up, and they're growing, and there's going to be more coming online over the next couple of years. So I don't know if actual current inventories is the right metric, but again, if anybody listening is an expert in warehousing, I'd love to get your comments. If you want to drop a comment in the comments there, drop a comment in the comments.
Well, manufacturing in general has declined since October. So if that trend continues, I think it'll support my thesis. But who knows?
I've seen it real world too. Actually, Amazon has started like broken ground, started to construct plants, and like you're seeing them abandon a few different sites as well too. So we had that whole COVID bump where it was like crazy amount of space was needed, and I think they might have overcorrected, and we'll see a bit of a whiplash from it.
Well, it's interesting. The ISM manufacturing report, which will tell us if manufacturing is continuing to decline in December, comes out about 3 hours after this podcast comes out tomorrow morning. So keep an eye on the ISM manufacturing report, and that'll give you an idea of the trajectory.
I'm going to rush over after this and check that out.
I like that you didn't play it safe, that you took a risk, because I kind of did the same thing. I went with some outliers, and a lot of things have to change to actually make my predictions come true. So,
well, so let's follow up here, Jay. With I want
to throw one more. I want to throw in a statistic because it took me a while to find it. But Morgan Stanley reports that e-commerce comprised 15% of total retail sales in 2019, increased to 22% in 2022, and they expect that number to reach 27% by 2026. So that's my argument, that the e-commerce market is growing irrespective of, manufacturing going down, and all those online stores need warehouses.
Well, unless they're drop shipping from China.
I mean, but every store needs warehouses, right? So like just because it's moving online doesn't mean that there's going to be more warehouses needed. It's just, like even Best Buy needs a warehouse. Like they don't keep all their products in house. Like yes, it'll be a little bit more, but
I'd actually break it up into a couple different categories though. I look at industrial in 3 major categories because they're very different. When you get into light industrial that is smaller, so if you're talking 5,000 square feet to 20,000 square feet, that is going to be gangbusters next year. And the reason being is nobody's building them. So the amount, when you're talking like that huge square footage, that square footage is being built at like 200 to 500,000 square feet to 1 million square feet, right? All in like big one location, where what I think we've seen, and this is in places where they're building huge industrial like Arizona, we've seen, though, the other market is being completely missed. Institutional capital, private equity, everything else. They don't want to be putting together 5 to 15,000 square foot flex spaces for 10 different tenants. It's lower margin, harder to manage, operate. You have turnover. There's these other problems with it, but that's created a massive spike when you're talking 25,000, even 50,000 square feet locations because of last mile. So these big, huge warehouses, they are hitting major demographic or major geographic areas, right? The new Inland Empire is in Arizona. It's not in California, and they service all of Southern California out of Phoenix. Whereas this last mile problem, that is a supply issue in flex industrial space to hit localized markets and service and local business servicing those local markets. And I think that those prices will go up, but I think the big warehouses, I'd agree with Jay, we'll see softening on those.
All right, let's pivot a little bit back to single family, and what a lot of people are going to be interested in is mortgage rates. What do we think mortgage rates are going to do here? AJ, you touched on it a little bit, that you thought they were going to go down a little bit, but why don't you elaborate on what you think they're going to be looking like for 2024?
Yeah, I think we'll have mortgage rates, I believe, will continue softening. And I believe we will see a downward trend. We don't expect and believe that we're going to see huge, major sustained drops. But the market over corrects and overprices those drops. So even if the Fed isn't dropping or being aggressive, I think we're just to see a softening on the 30-year. And every time that rate goes down, you're entering in a new buyer pool. So what that buyer pool is fragmented up against, meaning at 3% interest rate on a 30-year fixed mortgage, that buyer pool is huge, right? At 4%, it's still big. At 5%, it's dramatically dropped. You're from 3 to 5%, you probably cut out half the entire demand. Now, when you go up to 6, 7, and 8, that buying pool is shrinking a lot. So how much of an expansion the buyer pool will have from 6% or from 7% to 5%, I'm not terribly sure, but I do believe that softening of rates will increase the buyer pool. So sustained softening, but not a major drop.
Wait, so how low do you think they're going to get down to?
5.
Ooh, 5. So if I extrapolate, that means if you do a 5% interest rate, that means the 10-year treasury is right around 2.5.
5 to 6. Yeah, 10-year treasury at 3. That's what I was kind of basing it on. Because 10 years at 4, under 4 right now. So
yeah, I guess you could plausibly see a spread closer to 2 if once you see a little bit of the volatility out of the market, the mortgage market. Mm-hmm. So that's reasonable. Do you agree with that, Jay? We'll go with you next.
So I was going to say the 2.5 point spread between 10-year and mortgage rates right now is not historically high, but high historically. And so historically that number is somewhere between 1.5% and 1.7%. So if we were at historical averages, just use the word historical one more time, we're at like 4% federal funds rate. That would put mortgage rates at somewhere around 5.7% if things were where they naturally would be. And then on top of that, I mean, the Fed's pricing in or predicting 3 rate drops. So 3/4 of a point in 2024 potentially. So if I had to make a guess, and that's all it is a guess, I would go back to that historical average of 1.7 above the 10-year, which puts us at 5.7. Subtract out that 3/4 of a point in Fed rate drops, and I like AJ's expectation of about 5% by the end of next year.
But the rates aren't based off of the Fed rate; they're based off of the 10-year. So you think that a 3/4 rate drop is going to coincide? Like if the Fed brings it down from 5.25 down to 4.5, you think that's going to see the 10-year go from 4 down to 3.25?
I think, well, we still have a yield curve inversion, and we can talk about that when we get more into the economic stuff. That's going to have to correct. But I'm gonna suggest that 10-year is going to come down as federal funds come down.
Okay, but so you were just saying yourself though, the Fed funds, they're predicting a 1/4 point rate drop. You think it's going to be the same for the 10-year? 3/4,
yeah. I mean, without any other data to go on, yeah, that's going to be my guess.
Mauricio, you're skeptical. What are you thinking?
No, I actually hadn't looked at it in a while, but it's amazing that the 10-year went down from 4.9 in October all the way down to 3.7 not too long ago. Now it's like just under 4. I don't think the Fed rate is going to, I mean, this is already pricing in whatever people think that the Fed funds rate is going to go down. So they're already pricing in whatever freaking 3 25 point basis points. So that's already factored in. But no, I'm with you guys. I mean, I think interest rates are going to be going down. So I think the 10-year is going to be lower by the end of the year than it is today. The question I have, which is I think we can leave until the economic, is what does that mean? But no, I'm with you. I think it's less to do with the Fed, but I do think the 10-year, which is what really the more not exclusively, but it's not a direct correlation, but it's a very heavily correlated number, that the 10-year will be significantly lower, probably around that 3% range. So you guys would do the math in terms of what the mortgage rates will be. But I do think the interest rates will be lower. I just think they're going to be lower for different reasons, but which we can talk about.
So you're saying about the same thing. If the 10-year Treasury is right around 3%, then we're looking at mortgage rates in the 5%. If they get closer to historic, then maybe even below that 4.75. I kind of had the same thing. I had the Fed rate, but I went at a different way. I believe we are going to see a recession, or we're going to see let's call it the event. Something will happen. If I had to put my finger on it, it'd be the renewal of this credit facility for the banks. All of a sudden, people are going to realize that there's no.
Let's not get that's on my list. Don't get ahead of yourself, Kyle.
There's an issue there, and that's gonna all of a sudden the stock market is going to correct and go down. It's 10-20% then right around that time. But I don't know what the event will be. But whenever that happens, I think the Fed's going to drop down to 3.5. And when they do that, that's going to send the 10-year Treasury down to sub 3. And so that's when I think mortgage rates will be that sub 5%.
In the last time the Fed was at the 10-year was at 3+ was like 2011.
Yeah. Well, so we haven't had a recession since then. So
Kyle, what's your number?
So I think I'd say right around 5. Why, you writing this down? You're taking notes now? Should we go back?
I'm looking at the spreadsheet, and I'm just looking at what I was talking about. I mean, I was at that 4 to 5% by the end of I think it's going to be in that 4 to 5% for sure.
So should we go back and fact check Jay then, since he's so keen on writing down predictions and what exactly?
Yeah, Jay said at the end of the year, Jay thought it was going to be right around just below 6% as of 2 days ago. So,
and what did they end up?
About 6.6.
That's quite a ways off. You're acting all cocky, like I was almost there.
Yeah, I am, because things are trending in that direction. They're down from close to 8. They were at 7.8. They're now at 6.6. And the driving force has been basically the Fed pivoting and the 10-year dropping. And I think that's going to continue. And who knows, maybe I'm off by a few weeks, but I think we get to close to 6 over the next month or two.
All right. Fair enough. So Jay, I know their Mauricio and AJ's opinions. How do you think that's going to affect home values going in 2024?
I think we're going to see a slight softening in home values. I think nothing drastic. It's not going to be a 2008 type event. But my take is that there's going to be an economic softening that's going to precipitate some excess supply. People are going to start selling because they have to. And I know everybody thinks that there's so much pent up demand that when supply comes on the market, it's going to be absorbed and prices are going to stay where they are, or maybe even go up a little bit. But having been paying attention through 2008, it's clear to me that people's sentiments can change on the dime. And despite the fact that everybody's gung-ho to buy right now, I think the minute we start to see some economic softening and unemployment numbers going up and people start to get a little bit scared, I think people are going to get back into wait and see mode. And everybody says they're ready to throw money around, but I don't think that's going to be the case. So I think we're going to see some excess supply in 2024 if we have, and I think we will have, like an economic softening. And I don't think that we're going to see a corresponding amount of demand to pick up that supply. And I think we're going to see drops, if I had to pick a number, 2 to 5%.
All right. I'm going to agree and disagree. I'm going to agree that we will see an economic softening. As I already said, I think there's going to be some sort of recession or recessionary event, but this whole supply and demand thing, and how it's crazy how resilient the housing market has been, like through these like unprecedented rate increases. So to say that, like, if we see rate decreases, but then some kind of offsetting economic softening, like I just think the housing market has proven very resilient, and I think that it's going to default to kind of just this equilibrium of housing just kind of staying stagnant. That people are going to, the sellers are going to hold to their prices, and buyers are there's going to be a bit softening in the demand, and it's just going to hold steady. So I think we're going to see at max maybe like less than 1% increase in housing price.
Well, housing prices are up over 4% year over year. So in 2023, when we had the largest interest rate spike that like most of us have seen in our lifetime, right? Outside, if any millennials or anybody else, then, we had a 4.5. And I'm saying from the highs of what we saw, I mean, we could be way down from that. So, I look at that. Some other, it's only 16% of the houses that sold in 2023 were considered affordable, meaning that only 16% of the houses that sold were affordable based upon the median income in that area. And when you look at that, that makes you wonder, well, are people buying things that they can't afford? I actually think that it means that people and what they're buying is moving around and they're being more selective. So meaning you're getting subgroups that are doing the buying and then subgroups that we're buying that aren't at all. So you're just changing the makeup, I think, a lot of these buyers, who's buying and the inventory on the market. So if we're up over 4% in 2023, man, I got to assume that interest rates going down, we'll continue to see a rise.
I'm looking at, I want to throw out a couple, I'm not going to throw them up here, but like I'm looking at the Case-Shiller price index, and we peaked in June or July of 2022 at about 308. And then we got to September 2023 at 312. I mean, according to this Fed report from the Case-Shiller, we're basically flat over that period of time, maybe a little bit higher, but it's not significant. But the two graphs that I always love to see, because both of them literally show bubbles in the single family housing market. One is if you look at you just mentioned, AJ, the price to income ratios of the housing market, and you'll see that we're higher than we were back in 2008. So if you just look at the graph, you'll just imagine that it spikes up in 2008 and the price, I think, is at 6.75, and then it dips back down after the recession, and now we're higher than that. And then the other statistic that you look at, the other graph you look at, is if you just adjust for inflation and adjust for home size, which is another big one, because obviously homes have just gotten bigger over the years. You'll also see that graph showing we're even at higher levels than we were back in 2008. I'm not saying we're going to have a huge pop and collapse like we did in 2008, but it always reverts back to the mean. And we're nowhere near the mean of what it's been for the last 20, 30 years. We're higher than we were back in 2008.
Tell that to Europe or Australia or anywhere else that never reverted.
Yeah, there's
back
your price.
To the mean.
There's your price. As you can see over the last, I mean, we obviously had the huge run up from COVID and everything, but over the last 12 to 18 months, it's pretty much flat. It's a little bit higher. I mean, you can pick and choose, obviously, the bottom to the top. But I'm looking at, go ahead, Jay. I know I was looking at the home to price to income. I mean, in the housing bubble, it was 6.8, meaning the home price to medium household income. And today it's at 7.5. So from 6.8 to 7.5, when the medium's around 4.
Yeah, addressing your returning to the mean. And yeah, we do return to the mean. There will be a regression to the mean. Whether it happens in 3 months or 3 years, no one knows. But here's the bigger question. What is the mean? First of all, the mean is inflation. So if you look at that trend,
inflation, the one that I look at is the inflation adjusted. So if you look at inflation adjusted on the home prices from like literally from the 1900s to 1990, it's pretty. It goes up and down and it's flat. Then it went all the way up in 2008, and then it came back down to the mean, and now we're back up, going up again above 2008.
Absolutely. So that trend line is the inflation line. So there's two ways for us to get back prices to get back to that trend line. Number one, nominal values can drop. So the price of houses can go from 400,000 to 350,000. That's one way of getting back to the mean. That's what happened in 2008, 9, and 10. But there's another way of getting back to the mean, and that's for home prices to stay exactly where they are for the next 5 or 6 or 7 years, while inflation, that the trend line catches up to nominal values. And what I've been saying for the last year and a half is I think we're going to see the second. I think that home prices are going to be stagnant for the next 5 to 7 years. The trend line, the inflation line, is going to catch up, especially if we're above average inflation. If we're above our target 2% inflation, we're going to catch up even faster, and we're going to return to the mean. We're going to return to that
But
trend
you
line.
think in the short term, they're going to go down to 2 to 5% this year and kind of accelerate that before flattening off.
Yeah. I think it's going to be a combination of both. I just think it's going to be more of a waiting game for the inflation to catch up and less.
Because here's the problem that Mauricio, that Jay, I think is right about. Why? The reason being is you also right now have one of the most affordable that housing has ever been for homeowners, meaning that the vast majority of homeowners today bought and are holding interest rates at like 3%. And unless you bought in the last 3 years, your equity is astronomical.
Average is 3.6%
Yeah.
mortgage rate right now.
We've never had, when we talk about your the housing cost to income, that doesn't matter. Meaning that if housing doubled, but my payment dropped in half, even if my income went down by 30%, I'm still better off. Right. So the cost income to the housing prices is way more. It's not nearly as relevant as the cost to own the home. Right. So if I can own a home and I can afford it with my disposable income, right, then it doesn't really matter what the price of the home is. That becomes irrelevant.
That's a fair point.
People can always refi too, though. Like you can buy. They say as people like in times like this with high rates, they say date the rate, marry the home. So like you could get into a house with the plan on refining it later and then move up when the rate gets there. So like it's kind of just going to be supply and demand on that.
Yeah, but what do you do when you're unemployed and you have no income?
Well, no, okay, this is a great thing to look at it. Let's say that we got 6% unemployment. I mean, during the Great Recession, did we hit 10? Was it 8?
Yeah, we got to 14.1.
So 14% unemployment, which the unemployment did not result in the housing crisis, right? That's not what happened at all. And so when you look at, I think, too, unemployment numbers and housing, I've never seen data that is correlated with housing price. First of all, the housing market and unemployment. So if we had unemployment goes like this throughout the years, I've never seen housing market and prices go with.
Yeah, but you've never seen it because we've never been in a situation where you have people got interest rates at 3%, like in historically low interest rate environment. That's never happened before either. This is a very unusual situation where you have all these people.
So they should be better off. That's what I'm saying. So if I own a home at 9% interest rate on a 30-year mortgage and I get unemployed, that's way harder than if it's at 3 or 2.
Yeah, but also historically though, like if you looked at like someone sent me a clip before about when they were talking that interest rates went from 18% to 20%, and their point was like, oh, like interest rates are still historically low. But I look at the change that like, okay, interest rates went from 18% to 20%. That's going up 10%. Or sorry, that math's awful, but
yeah.
In that case, by going up 2% with historically low interest rates, you're doubling and tripling. So like that's the change in the monthly cost is much different than what happened right now. So people aren't going to give that up versus someone giving up an 18% mortgage rate versus a 20%.
Yeah, and I know we talked about it before, and maybe the numbers don't there's not enough of it, but like if there's that much equity that I've accumulated in my home and I now become unemployed and I'm part of that 8, 10, 12% unemployment rate, and I need to access money, I can't refinance. I can't tap into that money like I could like an ATM. The only way for me to access that equity is to sell and harvest that equity and then go either probably rent something else or go buy something. You wouldn't be able to buy something because you're unemployed. That's all I'm saying there. It's just when things aren't going well, there's going to be a high percentage of people, and that's just going to be a trickling effect because, as you guys know, single family homes.
But the question then comes is, okay, how much are the rates going to go down because of that recessionary event or whatever happens? And then how many people are who have been waiting to get out of their house and sell their house and buy a new house? How many people are going to buy that new house because the rates are lower? And is that going to offset
it? They're not. They're going to sell their house, not because they want to buy. They're going to sell their home, not because they want to buy another home. It's because they want to access the equity in their home so they can put food on their table.
But what about all those people who are paying $3,000 a month in an A-class apartment right now because they can't afford to buy a house because they're 7% interest rates? All of a sudden they can have that opportunity to be able to buy their house. So like the question is like, first of all, how severe is this recession? If we see a severe recession, obviously all bets are off. Like that's, blood in the streets. But if we see some sort of milder recession, that's why I think like this housing market's been resilient. And I think it's going to kind of just even each other out. And people have learned to hold to their prices. And if you're not desperate, don't sell. And the people that are desperate, we're just going to have this new crop of people who are all of a sudden buying because the rates are low.
I think we're living in an extreme environment from 2008. It got extreme one way and it reverted the other way. And we have to remember that millennials are the largest generation ever. And they are now all turning into home buyers right in the late 2017 on. And this group is ginormous. And in a period of time where the United States, from when they were teenagers, stopped building homes. So literally we had a whole mass cohort of population in high school that from their time in the high school, we stopped building homes in America. And now all of them are now coming of age in their 30s and trying to buy homes. And there's just not there's.
And Jay's got this home ownership rate up for the graph. And the argument that I had about the home ownership rate was before is, to AJ's point, these people are coming and they're becoming the age of buying houses, and they're not renting. They're staying with mom and dad. And so they're not contributing to this home ownership rate. They're actually considered like homeowners because they live in a house that is home. I don't know how you say it. It's home owned. But they live in one of those houses. They're not a renter. So we have all these millennials that are living with their parents, and they're not affecting this home ownership rate. So I feel like if we see this dip in interest rates, all those people are just going to come off the sidelines and they're chomping at the bit.
Yeah, I think so. Maybe this is another prediction we can make, but for those that aren't watching this, basically we're looking at the home ownership rate in the U.S. since 1960-ish or so. And what we see is that between 1960 and now, home ownership rate has always been between 63 and 69%. And for the last year or two, we've been right smack dab in the middle at 66%. So 2/3 of Americans own their own home. Where is this going from here? Is this going up or is this going down?
2/3 of Americans live in a home that is owned.
Correct. So where's this going from here? Up or down?
Well, I got one thing to say on this, and we can look up, but outside, what's that phenomenon with people? We have it where it's like, because it happened and we saw it, we think now that the possibility of it happening is way more.
Recency bias. In the United States, there has been literally only a few times ever that we saw even a softening in the housing market. Yep.
Ever. Softening. We had never seen a reduction in real home prices and values of anything that would be considered outside the realm of a normal thing until 2008. That was it. It was the first time we'd ever seen it. That's why it was so bad, because nobody even believed it could physically happen. Nobody believed it was possible for that to occur. So I always look at that and I say, listen, could it happen? Of course. But if I'm betting, the odds of that happening seems like, what would be the cause? Because first of all, rising interest rates had no effect on housing prices back when they went from 10% to 20% or 5% to 20%. It didn't have an effect last year, right? Unemployment doesn't have an effect on the housing market. We don't see, right, these huge changes in normal economic circumstances, even when we used to have much more common recessions and we had other problems, right, within the economy. And we still really didn't ever see that. That's not something that really occurred. So I don't know. I think that's a really hard bet to make.
Yeah, and just to reinforce that point, what we're looking at again, if you're watching this, is a chart of median sales price of houses going back to about 1960, and what we see is from 1960 to 2008ish, there was really never a drop of more than 1% or 2 in home values from year to year. We obviously saw a relatively big drop between 2008 and 2011, and then from there it was straight up until 2022. And then last year we saw a decent drop, actually probably the biggest drop in history. We talk about 2008 being the biggest drop in history, and it was actually, if you look at this chart here, it was actually 2022 that saw the biggest drop in history. But because there was such a big run up leading to it, I think a lot of people didn't really notice.
And
But
this is also the graph you're looking at too is the actual sale price too. Like the thing that happened in the previous year is there just were no sales. And so the data is pretty skewed for the last year.
It's skewed as well because you don't in this historical data, you don't have a overactive Fed manipulating stuff, right? You don't have a Fed that's, after 2008, they started to pull all these levers, and every time that now there's right, for example, I can, like 20 years ago or 30 years ago, if there was a huge recession, I would not be confident that the Fed would suddenly just drop rates to zero. But now we've seen over the past 20 years that that's their new playbook. If suddenly we have pain, especially in an election year, we don't want pain, that they're willing to go from whatever it is now, they'll go to zero if they need to. In like this, you could see interest rates. If we had a major recession, I have no doubt that you could see interest rates at zero.
Well, that's a good segue to move on to our next segment where I will recap just real quickly to wrap up the real estate section, but our predictions before. So we all kind of said that we thought the real estate values would remain flat for the second half of last year in our predictions episode, except for Mauricio. Unfortunately, Mauricio thought that recession was coming in October last year, and it did not. So he was off a little bit on his home values. He thought they were going to see a hit there. But as far as mortgage rates, AJ was almost dead on. He thought it was going to end the year at 7%. It's about 6.7 right now. I thought they were going to be closer to 6 and 6.25. Mauricio once again thought they were going to take a hit with the recession. That didn't happen, and Jay was right around 6. So that's the recap of those. But then move on to talks about recessions. So Mauricio sounds like he's just kind of pushed back his prediction from October to the beginning of the year next year. But
yeah, I mean, you and I, I think you and I, when we did that prediction show, were pretty much aligned except for the timing, and that's the tough one about timing. But yeah, no, I think we're absolutely going to see a recession. I think it's going to be a significant one. You're boxing in. You can't underestimate as much as people want to underestimate the power of the Fed. They have so much power to move levers to defer things that at this point I just don't even know how far they can defer. I mean, we're going to talk about this bank term funding program, but I mean, you can flood the market with liquidity and patch over anything, and maybe they kick the can down the road. I don't know, that 5 years, but eventually they're not going to.
So your prediction is there will be another recession in the history of the world.
In the next history of the world, we will see a major.
Last time we talked about it too, though, and you kind of pushed it back to Q1, but you thought it was going to be a significant recession. Are you holding?
Yeah,
to that?
I still think it's going to be a significant recession. The reason I picked October, as you guys know, or we talked about, like usually these things, something usually happens either in September or March, and so that's why I kind of went out on a limb on the September, October. I don't know when you want to get to before this podcast becomes 3 hours long. At some point, we're going to get to this bank term funding program that expires in March. But I know you've got some thoughts on that, Kyle. So maybe this is a good transition to talk about that. But that just happens to be in March, which again is usually when things tend to happen because people are rebalancing their portfolios, and you tend to see people swimming naked at the end.
Yeah, I agree that I don't necessarily think it's going to be as significant as you do. But I do think there's a bit of a storm brewing with it actually seemed like, if you're looking at the numbers that are obviously not all in, that the retail sales for the holiday season were actually pretty good.
Up 3%.
Yeah, I was unexpected to me. I thought they were going to be a little bit light with there just seemed like people were maxing out credit cards. Credit cards were all-time highs. The student loans were all of a sudden having to get paid right around they came back in October. But to Mauricio's point, people are, governments and people are all pretty good at kicking the can down the road as long as they can. It's just, when is that going to come to a head? And I think it's probably we're going to see that in Q1. And I think if we're going to talk about a black swan event, or what did somebody call it? I saw someone called it a gray rhino. I think that was MC Lobsher, what he called it a gray rhino because
MC, shout out to MC.
Yeah. And because his point was that everyone feels it, like it's rumbling, it's coming. You can hear and feel the rhino coming towards you. But it's not going to be a real black event. It's going to be a bit more of a smoother correction. And I hold to that. And I do think if I had to pick an event, it would be the bank term funding, because the Fed's kind of said, oh, everything's fine with the banking industry. And you know, to his point, like we haven't seen anything in the news for months and months about any bank problems, any bank issues, anything to go on the banks. Like you'd have to really go and search for anything that with as far as bank issues, or be like tapped into the credit markets like we are. So I think that's all of a sudden they're going to be like, hey, we're extending this temporary program, and it's going to kind of bring it back to the news cycle. And then people are going to look into these banks and see the issues that are still happening in these banks, and that's going to be it's going to be problems for the market in general. So yeah, I think it's going to be a smaller recession, end of Q1 March area.
Yeah, I'm fascinated. I'm actually super curious about this bank term funding program, because as you guys remember, back in March of last year, this is when the banking crisis was going on, and the Fed came in and extended these really ridiculous terms where they were basically taking all these treasuries off the books of the banks at par value, even though they'd lost a bunch of money, and loaning them at a really discounted rate. And that program expires in March 11th to be exact. And from all accounts, it sounds like they're not going to renew it. And I heard this really, Jay, I'm interested in your thoughts because you're the econ geek of the group. But yeah, it basically, when this program got launched, immediately we had about 60 billion, looked like 60 to 80 billion, really 60 right off the bat. Like the banks were just clamoring for cash, and they went and grabbed 60 billion. And I think most people think that, hey, that was it. Like March, there was a crisis and people came in and borrowed 60 billion or whatever, and then that was resolved. And what most people, I think, don't realize, look at the end of that chart too, is like right now we're at 120, 140 billion. So more than double now a year later. The one thing that you can't see, which is interesting, is how much of that is actually due to banks that are in trouble, that need the money, and how much of that is actually just an arbitrage play, because they're able to borrow, they're able to borrow money at, I think it's the last thing I saw was about 4.8%. And obviously fund rates are, much higher than that, about 50, 60 basis point higher. So banks can actually borrow money from the Fed at 4.8 and then go buy treasuries at 5.25. So there's an arbitrage. So I heard an interesting argument that may be one of the reasons why the Fed is actually thinking about pivoting and bringing those rates down to kind of eliminate that arbitrage. But I don't know, what percentage do you think, Jay, of this 130 billion, 130 to 140 billion that the banks are borrowing under supposedly, we're in strenuous terms at some point, I believe.
Emergency conditions.
Yeah, emergency funds. At some point, I think it's a 2-year window that those names of those banks are going to be revealed. But the bottom line is this: if that entire amount is banks that are in trouble and need that money to survive, then eliminating this program is going to be a huge issue. Like either it's going to be a huge issue or they're going to have to extend the program. On the other hand, if it's just an arbitrage play where most of this money is people are borrowing at 4.8% and doing a 56 basis point arbitrage, then it's obviously less of an issue. And as interest rates come down next year, then that's going to be less and less of a play, and they'll lead less of money. I don't know how you figure that part out. But if that's truly,
I think all it takes is one or two of them to be completely reliant on this, and then they fail.
Right. That's my point. Yeah. So even if you have like 20% or 30% of the banks that are using this money no longer have access to that money, then you create a banking crisis 2.0 that we had last year. And that could be a black swan. It could be an event that, because I think if you ask most people off the street, they would think that the program happened March of last year and the Fed solved the problem and there's no issues. When in fact, as you look at this graph, if you guys are looking on the graph on the YouTube channel, it initially spiked to 60 billion. And now it's consistent. Well, it kind of went flat for a little bit, but now it's spiked again in the last, what is that, Jay? Last, I don't know, 6 months or so. It's just suddenly spiked from about 110 billion to where it is now, 135 billion. Do you think that's actually, it's actually at 133, 638 right now. Do you think that's because banks are in trouble, or do you think that's an arbitrage play that's going on? And if either way, how do you know?
So I'm going to start with, I've been saying for 10 months now that I am not at all worried about banking. And maybe I'll regret saying that, but I'm going to double down on it and say that I have not, and I've said this since the Silicon Valley Bank thing, that I don't believe this is a crisis. I think the bank term.
Can you explain why though, Jay? Because if you're looking at this graph and you're suddenly seeing emergency money, like why do you think this emergency money the banks are grabbing is not an issue if they can't have access to it? It's like you're pulling their Amex card from them.
So the risk that we saw back last March was specifically around consumer sentiment, around banking sentiment. And it wasn't that banks didn't have reserves. It wasn't that the banks were having major liquidity issues. The problem was that the banks were underwater on bonds that they had said that they were planning to hold till maturity, long term. And assuming that they could hold those bonds to maturity, assuming they could hold them long term, they weren't going to lose any money. In fact, they were going to hit exactly their targets because they said.
But it was a liquidity issue though, because they were getting in the position where they were having to sell those to get liquid. And
yes, they were getting in that position because there was concern by customers that banks were in a liquidity issue. Banks were having liquidity issues, and so they went and they were taking out their money to not be the last person in line to get their money. And so those concerns about liquidity issues were generating liquidity issues. And it's just like we see in other parts of the economy. When consumers are concerned about inflation, we see inflation. When consumers are concerned about recession, we see recession. When consumers are concerned about bank liquidity, we see bank liquidity issues because there are runs on banks. And so if I'm a banker, if I'm running a bank, my thought process here is last March, we were at the height of concern over liquidity. The Fed rolls out, or the federal government rolls out the bank term funding program, and they say, hey, we're going to bail you out if you're having issues. And clearly there were some banks that took them up on that to the tune of $60 billion. Over the next month and a half after that, it went up to about $80 billion. Who are those banks that decided at that time, we're okay, we don't need to take this essentially free money from the Fed, and we're just going to keep going on as if nothing happened. And then suddenly 8, 9, 10 months later, they decide to start taking this money around the time that the Fed is coming up on that 1-year mark, and they could potentially be defunding this program. My take is that since about $80 billion, this has been arbitrage. And so for the last $60 billion of the money in taken from this fund, it's been arbitrage and it's been opportunistic, and banks basically saying, and I'm not saying the banks aren't saying, hey, let's backstop ourselves, but I don't believe that last 60 billion is banks that are in significant trouble.
Here's a question then for you, Jay. So we agree that the reason that they got in trouble in the beginning is because they did need the liquidity. They needed to sell these treasuries that were long dated, that they hadn't planned on selling. So we keep hearing all this time about all this capital that's sitting on the sidelines, and people, how much money people can make just having money in the bank. If we see a reduction in interest rates, isn't it like reasonable to believe that this money is going to make its way out of the banks and then all of a sudden go into assets? And then therefore these banks are going to need liquidity again, and it's going to be an issue?
I think that there's very little chance that the Fed actually cuts off this program. I'm not saying they're not talking about it. I think that's kind of a bluff on their part to put banks in a position where they're either going to need to declare that they're having issues right now and take money, or basically admit that they're not having issues.
So isn't that going to be enough though for a recession? If all of a sudden they're basically admitting, hey, like these banks do need this, we do still have banking issues. Don't you think that could trigger a some sort of correction?
Yeah, I don't think it's going to happen. And if you looked at the banks that had the problem back in March, they were banks that were heavily overinvested in loans that were high risk. So venture debt, personal loans to tech founders, things like that. That money was basically being thrown around in sectors that we don't see typical local and regional banks throw money around in. And so I think it was a very concentrated crisis, if you want to use that word, back in March. I don't think it was nearly as broad. And I know we talk about the risk of office loans to regional banks and the risk of multifamily to regional banks. And I'm not saying there's no risk there. I think it's overblown, and I don't think it's manufactured. I just think that things aren't nearly as bad as.
But that risk is still there. The commercial real estate risk is still there, and I just think no one's in the mainstream media is looking at it. And the moment they extend this program, people are all of a sudden say, "Oh, wait, is there still problems with the banks?" And then it starts becoming news story. There's still problems with the banks, yada yada yada, and that's how it happens.
And that's a good point. I don't know if they're going to extend it. I mean, I thought there's a good chance they may extend it, although I have seen the media reporting that it's probably not going to happen because of the arbitrage. But don't forget that these banks that took out the arbitrage, there is going to be a little bit of a stigma because that information is going to get released. I thought it was 2 years after. I was just looking it up. It might be a year. I'm not sure if it's 1 or 2 years, but at some point that's going to get released. And so I just don't. Consumer sentiment is so fragile that if you have an issue where in March 11th, they don't extend it and then rumor starts running that, hey, your bank is in trouble now again because they were the ones that were using this facility. Now that facility is gone. You don't think there's going to be another bank run again? People getting their money out of there to go to the next one?
I don't think the typical American even knows that this program exists.
But they will.
But they're going to know when they say your bank, your local bank is suddenly, people are pulling
out
their money.
You're right, though, Mauricio. They still have time. I think it was at least 2 years until they have to.
Yeah, I want to say I think it was 2 years. But that's another point about the arbitrage. It's like, do you want to arbitrage to make a lot of money if you arbitrage it, but knowing that 2 years from now, which is now only a year away, you're going to be on that list of banks that access that emergency funding. You're going to have a PR spin big time to say, hey, we only used it for arbitrage and we made a bunch of money. That's the only reason I don't even know if they're really allowed to say that. The Fed's going to be pretty pissed if they say that. So I don't know. I just think it's potentially something that at least you got to be aware of. And that date's March 11th. And I'll be curious to see if they do extend it and then how much media coverage it gets.
All right. Well, Jay, so you don't think this is going to trigger a recession? Do you think a recession is going to get triggered another way? Do you think it's going to happen in 2024?
Yeah, I do. And this goes back to, I'm a big fan of the yield curve. The yield curve is basically that plotting of yields for government treasury bonds. And we normally see a curve that goes in a certain pattern. And historically, every time we see that curve go in an opposite pattern, it portends a recession. And so basically every recession since 1960 has been preceded by this yield curve inversion. Every yield curve inversion has led to a recession since 1960, and every recession except for one has been preceded by a yield curve inversion. We've now had the longest yield curve inversion in history,
and deepest, by the way,
like the biggest spread between bond yields. And it's going back. I looked it up earlier today to see how far back it went. July 6th of 2022. So next week or a couple days from now will be 18 months that we've had this yield curve inversion. And so I'm a big believer that history is a great predictor of the future. And so I do think we're going to see a recession. Now, that said, if you look at history, I mean, sometimes there's a pretty long lag between the inversion and the recession. But we've been at 18 months now. So I do think that it's coming. I don't think it's going to be a huge recession.
Well, the trigger is usually when it reverts, right? That the recession.
And that's the other thing that, like, there's just not enough data. We're talking about 8 or 9 recessions here, and it's hard to tell, is it triggered by the reversion or does the clock start at the time of the inversion? And I'm not smart enough. I don't know if anybody's smart enough to really be able to, and again, it may not be a direct causal relationship. It may just be something coincident for some reason that we don't fully understand. But long story short, I think we're going to see a recession. I think that the Fed has enough runway with interest rates. I think in an election year, there's enough wherewithal to avoid it as much as possible. And I think at the end of the day, we're going to see some softening. We're going to see a blip in unemployment. And I know I go back and forth on this. This was my take a year ago, and then 6 months ago, I was in panic mode, and now I'm back to I'm not really concerned. But there's my prediction now. I think we'll see a small recession, and I don't think it's going to be bad by any means.
Sticking on brand there, Jay, going with the classic economic response of history will repeat itself. AJ, what do you think? Let's finish off this.
I'm going to stick with that response for as long as history continues to repeat itself.
AJ, what do you think? We seen a recession in 2024. Is it going to be a bad one, or we're going to stave this off?
I don't think necessarily it will be a bad one, but I'm not nearly as concerned. I think a lot of the things that have been mentioned as I am other things, geopolitical, and the current status of the United States. Those things concern me. We have a pretty big problem in the United States where, first of all, people think it's really bad. And we've been doing a whole series on this, and I'm building this out. But what people today are willing to riot over and actually burn the system down is mind-boggling, because they think they're in bad shape. Now, there is basically no numbers that not only not support that, but it couldn't be further from the truth. Disposable income is sky high compared to what it used to be. Home ownership, millennials are complaining, oh, well, we can't own a home. You own more homes than anybody else. What are you talking about? And two, they're complaining about how much the home cost. Well, your parents, who you're comparing yourself, average home size was 900 square feet. And they had one car in a family of 5. Every American has a car today. And the average home size is 2,700 square feet with granite countertops. The Greatest Generation, 35% of the homes didn't have home appliances or plumbing. We work half the time that we did 2 generations ago. Our disposable income, we used to spend 85% on the bare necessities just to live. That is housing, clothes, and food. Nothing else. Our expenditures for non-necessities went from 20% to over 45%. So we have healthcare, by the way. Healthcare.
Or you could just say millennials have a different definition of what is a necessity.
Yeah, you're exactly right. Netflix, they think, is a necessity.
Mental health is a necessity, AJ.
Yeah. Healthcare went from, as such a problem, it went from 5% expenditure in the United States to 6%. There's literally almost no category that you can even find, even though it went to 12% of our GDP. So that means we can keep people longer, life twice as longer, yet our expenditures per person only went up 1%.
I guess I was getting more on that, we need our vacation time. We need our breaks. We need our fun stuff for mental health.
Yep. Paid holidays, all this kind of stuff. That none of that stuff existed. They work a fraction of the time. Our grandparents worked more by June than we do all year. And none of the time off that they had was paid off. And so when you look at, I think, the United States, we have these facts and these numbers that are very concerning, because there's no social poll that you can take that says, first of all, the United States is in a much worse position. Crime's a perfect example. People think crime has been cut in half in just the last 20 years. Poverty in the United States is at its lowest rate, even though you would think that there's just homeless people everywhere. And it's like, well, California is not everywhere. That's just Mauricio's problem, not everybody else's. But there's a huge misunderstanding right now in the United States of where we actually are and how good we actually have it. And that, to me, terrifies me, because what's happening is you can have one little thing happen and the United States shuts down over it. We start burning down cities. How are we going to be able to deal with real problems and geopolitical problems and things when it comes? I think it's leading us to a lot of those issues. I don't think economically.
Do you think one of these problems are going to come to a head in 2024, or do you think it's
That's my concern, because economically, I'm not that concerned about a recession. I'm not terribly concerned about the banking situation, because we just know the Fed will do whatever. They'll just give money, just throw it away. They'll kick cans down the road.
There's quite a few things going on. We got a couple wars. We have Thailand has an election coming up this year, and there's with China, Thailand. There's
lots of elections this year.
Yeah, I think UK and.
But AJ, do you think? I mean, AJ, that was a 100%. That was a great point you brought up. The question is that, do you think, another reason why the Fed will do whatever it takes? Like you said, it can paper over a lot of things. If there's a huge recession and before unemployment gets to 20%, the Fed can come in and give everybody $1 million, and then suddenly, everything's fine for the next few weeks, right?
Yeah. I think that we are in a position where, like we've talked about, not only with the Fed, but also to Americans in general. First of all, there's more than Americans can do to stave off real problems. Once again, the expenditures on non-necessities has gotten ginormous, right? And so Americans are better in a lot of different ways. Take alone safety nets. The safety nets that we have today didn't even exist, but to our parents, that didn't even exist, right? So we have safety nets. We have all these things going on. Now, that runs into a much bigger problem, which is long-term, which I'm not talking about here. So I think short-term, we have the risk for next year with the election year going on. I'm very concerned about social problems and geopolitical problems with 2 wars now that are going on in Asia now in the position where it is and where we're worried about it. The economic problems at home, outside of Black Swan, something that none of us can see or know, which always happens, right? I don't. But even if that happened, we're at interest rates where the Fed can drop them. The Fed didn't have this power for a long time. The Fed now can go from what interest rates are today to 0. That would act like gas on our economy. I mean, it would just blow this economy up. So they have more tools. So maybe I'm totally wrong here, but economically, I'm not nearly as concerned as I am geopolitically and socially that we will have issues, because I believe that America is so incredibly out to lunch with how amazing that they have it, because they are comparing themselves to what they think it is and not the rest of the world nor our history. And I think that's a huge problem.
Great point. All right, we have one more big subject to get through, and then we can kind of rattle off some smaller, quick, fun ones.
We've kind of gone long on the 2. That we're going to skip the top 10.
Yes,
we can skip the top 10.
Mauricio's like, please skip the top 10, please.
Yeah, because the top 10 is like 40 seconds long, but it's okay. We'll let you go on about the Fed credit funding facility for a half hour, and we'll skip the top 10. All right, inflation. Do we think it's done? It's going to keep heading down. Do we think it's going to return? Do we think we're going to hit 2%? What do we think? Jay, go.
Slow drop to 2.5% by the end of the year.
Mauricio.
I mean, for the year, it's who knows. Yeah, I'm with Jay. I'm good with that. I just think that by the end of the decade, though, you're going to see another spike, and we'll get higher than we were before.
I don't think it's gone. I think it's more under control for me. I think 2.5 to 3.5. So I'd target it at 3. But I think it will. I think we'll probably get some short-term spikes and then some calm downs. I don't think we're.
So AJ, it seems like you're of the last mile perspective, where like we're coming down quick, but then it's going to be much harder to get that last mile down to 2%.
Here's my question on the inflation, though. This is the key question that you got to ask yourself, right? When will the Fed give everybody $10,000? Because when the Fed gives everybody $10,000, then we're going to see inflation 12 to 18 months after that.
Well, so we still got 12, 18 months. We're only talking about 2024 right now. My position is everyone's like talks about this last mile where it's going to be so much harder for the last mile. I don't, and no one ever really says why. I don't, and I haven't seen a good explanation of why the last mile is going to be harder. Like, yes, it makes sense that it would be harder, but I haven't seen any data as to why this would be harder. And I keep saying how lagging the things like rents and things like for the core PCE. So I think core PCE is going to hit 2%. I think we're going to hit our target this year. And I attribute that to, like, if you look at this alternative index that I quote before from Penn State, they already have core PCE at 1.7, and their whole purpose of that is to try and take out some of the lagging effects, mainly of rents and things like that. We saw PPI negative last month. So I think we're hitting 2%. I don't think we have any issues. I know I'm probably going to be the bold prediction on this one, and you'll clip this and I'll be wrong, but that's my prediction on that one. Mauricio following suit. He must have had the same amount as me to drink. Cricket hat time.
I'm just going to start mimicking Kyle whenever his hat goes, out of ways.
All right. Stock market, quite the run up we had in the stock market the last few months. We all kind of got that wrong. I was kind of close. My timing was off, but for the most part, we all got it wrong in our last prediction episode. So how do we think the stock market's going to perform 2024? Mauricio, get that yawn out. Let's go.
I couldn't give a rat's ass about the freaking stock market. So who gives
I agree.
shit?
Move on.
No one's invested in the stock market at all, huh?
Not much.
AJ?
I'll take flat. I think that we could see a big drop of the year. I think the run up was premature. We'll have a pullback, but then I think it'll go back. But end of the year, I think it'll flatten.
I see. I think the stock market has shown that people they love to panic either way. They love to, the slightest bad news or good news, they love to just jump in or jump out so quickly that I think when the event, I'll go back to the event happens, whatever that event happens, we're going to see a tank of like 10, 20%. But then people will, calmer heads will prevail and it'll come back up. And I think we're going to finish. We'll be lower than we are now, though. It's not going to run all the way back up. We'll be, somewhere that 4,300 versus what we have 4,800 now.
I'll jump in there and say I don't even know what the stock market is now, but it'll be down significantly because that's usually what makes the Fed freak out. Like if everything goes down normally and goes down 5% or 10%, like they're good. It's when the stock market collapses and suddenly goes down 1,000 points a day, like it was back in 2020. That's when the Fed really starts freaking out. So maybe at the end of the day, it ends up flat, but not before you have a huge swing downwards. Because I still believe that the Fed is going to freak out and reduce rates significantly, and the stock market is probably going to be one of those catalysts.
I agree with that. And Mauricio, why don't you follow that up with your gold prediction? Because you tried to sneak it in earlier. What do you think gold's going to do this year?
Gold is going to be the best performing asset of 2024.
So we're at 2,000 right now. Where do you think it's going to? Do you go to the moon or?
No. 20. It's probably going to be up 10. It doesn't matter. Everything else is going to go down. So it could be up 1%. And it doesn't even matter. So it'll be up. I don't know, 10%.
Well, it's still significant. Jay, you agree with that?
I don't care. I'm going to say substantially flat, like the stock market.
Okay, so Jay has nothing in the stock market and owns no gold. AJ, what about you?
Actually, that is not true. I own a bunch of physical gold and silver, and I still think it's
you're one of the doomsday people with it snuck under your bed then.
If you want to get Jay pumped, you got to talk about thoroughbreds, not gold, thoroughbreds.
They are going up in 2024.
That might be the best performing asset is horse racers. Horses that race. Did I say that right? Ashley, did I say that right, Ashley? Horses that race.
or alcohol, if we believe in a recession. Isn't that the asset class you want to be in during recessions is alcohol?
Yep.
AJ, you got any opinion on gold?
I think gold will be up, but I don't think it's going to be dramatic. I would target a 4 to 8%.
Yeah, I'm closer with AJ there because it used to be that gold was the recession hedge, but then I don't know, in the last few years, it seems like they've kind of broken away from traditional reasoning for why people hold gold. They usually hold it as a hedge, but now it seems like kind of the new generation holds gold as like just as an asset, not necessarily as a hedge. And you kind of see it mimicking crypto a little bit where, when people have money to spend, they buy gold, contrary to historical. So I do see it going up because I don't see any reason for it to go down. It could happen, but not significant. And like Mauricio was saying with that much. Real quick, anyone want to throw out a company or stock or anything that people should keep an eye on that's non-real estate other than gold? Jay?
Microsoft and Google. They'll be leading the AI surge next year, I think.
I agree with that. I think the tech companies, their margins, how much control they have over it, efficiencies, it's the new hype, whether it's how it plays out, the hype's the hype, and stock markets will trade, or those stocks that have it will trade at higher multiples. And I think that they're going to be allocating a lot more of their funds and income into those technologies, which will then further exacerbate the hype. And then any solid news out of it all will just keep it going. So if I'm betting on stocks at all, Google, Microsoft, they're so far ahead in these games now. it's hard to, they're going to be the winners if there are, and everybody thinks there are winners.
Mauricio, what about you?
Let's talk about Bitcoin. The question is this the new bull, or are we going to dip back to, 25 in August and then 17? I picked up some below 25 and got out. I don't know. The question is, are you going to see an all-time high, or are you going to see back to not all-time lows, but the lows of the recent times at 16 and a half? That is a question. Do you know the answer?
Nope. How about you?
Well, this is the bold prediction. So that's you got to actually make a prediction.
I'm going to say that we're going to go back. We're going to see. Here's my prediction. You're going to see 25. It's at 45 now. 25 before you see an all-time high of whatever it was, 67 or something.
All right. Well, the last time we talked about this, you said definitely going to be below 20, but definitely going sub 20 before it goes to 50, or 60. So we're much closer to 50 right now than we are 20. So
we are indeed. And we're at that new pivot there at 45. So yeah, we'll see.
We'll see. All right. I think we should keep an eye on, I'm going to go with a topic that we talked about before with real estate brokerages. They've rebounded a little bit, and I think they're something to watch right now, because we kind of had a perfect storm there of why they all tanked with you had the whole fiasco with the how they were doing the the commissions and NAR, and all these things happened all at once, and we have had record low transactions, and all these things have kind of all happened at once to these real estate brokerages. And I think the commission fiasco was overblown. I think transactions will pick up, and so I think real estate brokerages will see some good times coming in 2024. So
can I ask a selfish question?
Yeah.
Predictions: multifamily transaction volume. Where are we in 2020? Higher or lower?
Higher, but not by much.
So much higher.
Like how much? Like what? Give me a percentage, because my livelihood depends on this number, Kyle. Come on.
25% higher, at least, maybe 50% higher. 2023 was just a staring contest. It was basically just,
there was a 63% drop in at least in the syndication world anyway, from transaction volume.
Yeah, it was a staring contest of buyers and sellers just staring at each other, waiting for someone to blink. And interest rates have already come down, and I think just we've had some good news in the economy, and banks just that upside of the interest rates, the Fed not kind of saying, hey, we're not raising any more higher. Banks will turn the faucets on a little bit more, make it easier for us to get capital, and that'll give people a little bit more confidence in their underwriting, that they'll be able to get these loans. And I think it's gonna, people have been chomping at the bit. They need to buy things, keep the lights on. The machine doesn't work very well if you don't buy and sell any properties.
I bet you we'll double our acquisitions from last year to this year, if not 3x it. I mean, already in our pipelines, everything else, it'll be significant increase.
Oh, somebody already had their goal setting meeting for the year down there, AJ. I see you. Okay.
Jay, multifamily doubling and tripling in transaction volume?
I don't think it'll be up that much. I think it'll end up halfway between where we were 2023 and 2022, which is a significant increase, I guess. But we're not going to get back to 2022 numbers anytime soon. But I like your business for next year, Mauricio.
Yeah, I'd agree, Mauricio.
Well, we got to get this wrapped up, because I could tell, because I just got Jay's checking emails right now. I got an email from him. So let's finish off with election predictions.
Apparently you're checking email too, because you got it.
I got it. It popped up on my watch, actually. Thank you very much.
Wait. Let me just get something straight. You guys are still, I know AJ's not. Are you guys still checking your own emails?
Yeah.
What the hell's going on? AJ, what is wrong with these people?
Come on, guys.
Come on, dude. Come on. You got to step up.
Well, I'm just holding off.
My investors know that when they need to get in touch with somebody, they can get in touch with me.
Oh, good plug there, Jay. I like that spin. Mine was just going to be, I know AAI is going to take care of it.
My investors know that we have enough infrastructure where it's not reliant on me, and so they can not have to worry about it.
One year from now, AAI is going to take care of it, so I'd rather not set something up right now. I'll just wait for the AAI to get there.
Wait for the AI just to do it.
I think we all still agree that Biden and Trump are still the lead candidates, so we can skip over the The
Well, wait
election
a second. Who's
prediction.
going to win? Who's going to win?
Who's going to win?
Yeah.
If it's Biden and Trump, I think Biden still got him. It's we've seen this show before.
I did look at your spreadsheet during the show because I was like, I did predict that Trump would have to bow out because of some event related to his indictment. That's starting to look more and more plausible. We'll see.
I don't know. He's got some pretty high priced lawyers who are pretty good at delaying. And the moment we get to that election time,
is Giuliani on that list?
Giuliani,
not anymore.
Under the bus. Okay. And finally, one last prediction. Do we think that Taylor Swift and Travis Kelce will still be together after the football season is done?
I think a better question is the beginning of next football season.
Is that Travis Kelce's girlfriend or wife? Who is that?
You know,
I think he's serious.
I would be more surprised if he didn't know who Travis Kelce is based on the him not wanting to join the fantasy football league. But so what do you think, Jay? Are they going to make it through 2024 or what? How long are they making it?
Are they still? They're still together?
They're still together, going strong. She was at the last game. She was cheering him on. She was telling the ref to fuck off on the one call. It was great. They were reading lips. It was fun.
When is his contract up?
When's Kelsey's in Kansas City for life?
But I mean, like when's he have to renew or renegotiate?
That's a good question. I don't think it's anytime soon. He signed a long-term deal a few years back.
Oh yeah, then they're done.
I heard Taylor's a big fan of the show, and I think you should do whatever you want. Just enjoy life. Don't let anybody tell you differently. You just go girl. You go girl.
That's right. Slay queen, right? She's actually from Reading, right up the road here. So I think Ashley met her. That one of the benefits of when I was playing pro hockey is we would go on the road whenever they would bring in like acts like Taylor Swift would play in our stadiums, and all the wives would get to go and meet the people. So Ashley will tell you her favorite one was Enrique, which is weird.
That's good. No, that's a good one
as a husband. But yeah, we'll move on to that. Okay. Let's wrap this up. We could skip the top 10. The top 10 was just going to be it was just going to be the top 10. What's it called? New Year's resolutions, but they're all just like.
I'm going to do, just for the record, we talked about this last week. I was going to do it this week, but we'll do it next week. I am going to do the top 10 next week about the worst top 10 that you've ever done. So I'll do that next week.
All right. I'll hold you to that. I'm not going to come prepared. But yeah, I'll just do a quick summary of of what the top 10 was going to be. It's going to be top 10.
I thought we weren't doing it.
We're not doing it, but it was just all health and fitness. And
no, we don't want a summary. No, we don't want to waste time on the summry. Let's move on. Who are we plugging tonight?
Fine. All right. Well, I'll do a fun one that's not a waste of time.
Who are we plugging tonight? I want to know who we're plugging.
No, we got to do one fun game. We always got to end it with a fun game. Do you shower at night or shower in the morning? Huge debate going on online right now. What do you do, Jay?
Only in the morning because I get bedhead and it can't be fixed except with a shower.
So you just dirty sheets. Okay, Mauricio.
Morning. Who else? Is there another option?
Well, so the option is that basically you have a nice clean bed, and every night, like especially people who live in the city, they don't want to put the city filth into their bed, so they shower the night before.
And then the rest of the world has to deal with your filth for the rest of the day.
Well, what are you, a big sweater at night? Like you just leak right through your sheets?
Like you know,
turn the temperature down. AJ,
I just feel bad for Ashley. That's all. I'm just saying.
Mornings, 50% of the time, both.
Oh, yeah,
do you wait? But do you shampoo your beard every day, or does that vary?
Wax. He waxes.
Wax. Yeah, wax. Now I'm not like you don't just shower more, just to run the water over your head. Feels good, right? Like that's it.
Fair enough. I lean to the morning. I do it based off of need basis. So I'm usually showering once or twice a day based off of workouts and stuff, but it's usually in the morning. So I was arguing for the sake of arguing in there. But
Jay, this is the issue. Like when Jay, when you're as hairy as these other two guys, you got to shower multiple times a day. When you're like us, we don't have any hair, you can just shower once a week.
Yeah. when you're like me and Kyle and still have testosterone left, it's.
Yeah, I was just gonna say these old guys over here, they only get laid once a week, so they're showering once a week.
Wait,
and they're fine with it. We got to shower twice a day.
Once a week? I wish.
All right. Other than obviously not your wife, Jay, who you got to plug tonight?
I don't have anything, and we're running long, so I'm going to give away my plug.
Oh, okay. You're going to butt the plug to the next guy. Mauricio, what do you got?
I'm plugging my YouTube channel. It's a couple of videos have gone viral for me. So just go to YouTube, Mauricio Raoult, and subscribe. I got some big goals, good videos out there. So YouTube.
Actually, the easiest way to get to Mauricio's is to go to our YouTube page and then link off of that to Mauricio's. So why don't you go ahead and do it that way? AJ, what do you got for us?
My newsletter coming out, putting a lot of information that we've talked about and everything. We're spending a lot of time on that. So go check it out. It's getting
how do I get I'm not even on your newsletter. How do I get on your newsletter?
Follow the link in the description right here that we put in, so you don't even need to leave YouTube.
Hey Mauricio, speaking of your shorts, how's our shorts for this podcast doing?
I have no idea.
It looks like we haven't had one since November 14th.
Somebody should do something about that.
I thought that was your one job.
Don't worry, we'll get AJ's assistant number 42 does strictly YouTube shorts. So we'll just
speaking of AJ's awesome team, if you check out drunkrealestateshow.com, we now have a website thanks to AJ's team.
There you go. There's your plug. Check out our website.
And it looks good too. Everybody should go check it out. Yeah.
What's that URL again, Jay?
drunkrealestateshow.com.
And make sure you go, because there's a drunkrealestate.com. Don't go to drunkrealestate.com. Go to drunkrealestateshow.com.
Maybe we'll pony up and we'll offer her a bunch of money to take Drunk Real Estate off her hands. All right, guys. Well, I'm going to plug my wife as usual because I did shower today. I'll probably shower again tonight. So there's a better chance she'll be happy. But go check her out on the socials. Badass Investor on both Instagram, YouTube are her two major platforms. She has TikTok, I think, too, but I don't encourage anyone to go to TikTok. So check her out on Instagram and YouTube. All right, let's wrap this up. We had a good show, but a long show. It was good to see you guys. I missed you. It's always good to be back. But then I think is it Mauricio or AJ's ditching us next week? So we got to we're gonna fill in for that.
2 weeks.
Yeah,
That's 2 weeks.
2 weeks. I'm gone. Philippines, Dubai, probably Israel at this point.
Taylor Swift is filling in for AJ next week, so tune in.
That's right.
we had a really good fill in, but unfortunately, timing didn't work out. So back to the drawing board on the fill in.
Okay, so
Dude, by the way, whoever's going to end up filling is going to feel really bad with that intro right there, Jay. That was the worst.
They will be very high on my second choice list.
Taylor Swift can be our Matt Damon. Where sorry Matt Damon, we didn't have time for you. Taylor Swift, we didn't have time for on this episode. But I don't know about you guys, but my drink's been gone for a while. So I've been jonesing to go hit the head. So I will see you next Tuesday.
See you guys
Later.